Good morning, traders and investors. It is Tuesday, November 18th. We got a little action this morning with the stock market opening, set to open about 0.5% lower. We are seeing bonds trade a bit higher, gold down as well. So let's just take a look at the markets. If we take a look at the SP 500, we can look at it both on the 30-minute chart where we got into an oversold territory, started to lose some momentum with orange bars. And of course, yesterday again, losing more momentum back into orange bars, telling us this market doesn't know really what to do. It's running out of that momentum. We've had a couple waves to the downside. We did break a low here, but the overall cycles and the momentum and the money flow has turned a little bit south here, turned down. So we'll see how this unfolds. We have a trend exit both on the QQQ from a couple days ago. We also have it on the SP 500 to close out SPY with the ACS strategy. Also close the SSO since this market is not performing and it's not finding a bid. There's more sellers than anything else. So we want to step aside. If we are to take a look at the overall trend analysis of the markets, you can see where we're at here with the SPY down about 2.5%. It is set to open 0.5% lower, so down about 3%. And this overall position on our ACS portfolio is 30%. So it ends up really only being about a 1% pullback or loss on our portfolio. Now, mind you, we did lock in 3% on half of our QQQ trade. So again, it's going to be a very small loss. This is the joys of managing our risk and hitting targets and exiting positions like the QQQ, which makes this trade a very, very small loss. We had the upside potential if the market continued to run, just like on these other signals. We would have done well and continued to grow our account. Allows us to get involved. And of course, if it doesn't work out, we generally don't lose our shirts. And that is the whole point of this strategy, is to have the upside potential and control the downside loss when things roll over. Now, if we are to look at this market condition, kind of where we are here, it could be and looks and feels quite a bit like over here where we have a nice trend. The market, you end up kind of getting in kind of as it starts a new uptrend and then it struggles and stalls out. And then it went into obviously a much bigger pullback. Maybe we're going to see something similar to that here. We kind of got in up here once the trend kicked in. Since then, it's been struggling, and now we're going to have red bars. And for all we know, this market may want to go into a end-of-year sell-off. Seasonality-wise, it does show we should see strength, but that doesn't always happen, and we'll just have to be prepared for that. If we take a look at the QQQ, very similar type of price action when we saw back over here earlier in the year. The market had some volatility, pushed up, and then, of course, eventually rolled over. We're kind of in this same boat. It's had this push up. It's struggling to find a bid. It's underperforming, and we could very easily see a bigger correction. Obviously, this has been a big move up, so a big pullback would also help relieve some of this overbought market condition, this big rally that's been in place there. Now, if we take a look at the hot list as well, the hot list, the key here is to look at the sentiment. Most sectors have money flowing out of them. Most short-term trends are down, and the majority, 2/3 of the longer-term trends are more or less in a topping phase distribution, so some heavy selling, or they're already kind of in a bearish bias. So the market tide is definitely going down. Of course, we don't want to hold it. So that is why we are doing what we're doing. Some of you have been talking about why are we getting out of gold in the band strategy. Gold is just a trade. I don't know how many times I have to say this, but just because you like gold and I issue a gold trade with a strategy doesn't mean we just ditch the strategy. If you like gold, you can trade that on the side. I do still believe gold is going to do fairly well and have that push higher. But again, you just have to either decide to follow the strategy or do your own thing. That's up to you. But don't fall in love with the position. If you got into the GLD trade because it's a gold trade and you like the precious metal space, you probably already have a bunch of other gold plays. So you don't need to like stock up and have a full basket all in the precious metal space. You already have that position in place. So it's very easy for gold to potentially sell off and move down with this market. It doesn't have to move higher just because we have a bullish outlook longer term in the stage. Again, price is the ultimate barometer of where it's going, right? If you want to know what it's like outside, just go outside. Well, you don't look at the forecast, right? The same with the stock market. You want to know what it's doing, look at the price action, don't go to opinions. So let's go take a look at the bigger picture here. Let's take a look at what happened in 2007. So we saw the stock market start to sell off. It fell about 20%. And gold for that same window rallied 31%. Now that's the scenario we're all looking for and ideally would love to see. The stock market is showing signs of weakness. We have an exit signal saying the trend could go into a bigger pullback, which means money could start to flow into precious metals. Now, if we were to go back into 2000 and the 2000 peak, which a bunch of you want me to cover here, well, you can see when the stock market made a peak back in, this is 2000, we actually saw gold sell off with the first wave of the stock market. Gold sold off about 8 or 9%, somewhere in there. You can probably get a little closer. But it sold off about 8% while the stock market sold off as well. And then eventually we saw the stock market, it had some bounces and it continued to drop another 29%. And we saw gold start to move higher by 26%. And so who knows what gold is going to do? It could easily sell off with the stock market here. And that's why we need to manage our positions and not fall in love with them, because there's two sides to every coin and it's a coin toss. That's why we have to follow positions. That's how our ACS strategy, gives us potential to make money, but it really contains our downside risk. And we don't have to stress and worry about it too much. So that's what we're doing with gold in terms of, if you're in the band strategy and you've got the GLD, or you just pick the one GLD trade because you like gold, which I know many of you did, your best is to stick with the strategy. And so anyways, another member was wondering, why is there so much action in band and not so much in the ACS strategy? Well, it's pretty straightforward. There's 5 trades in the band strategy. There is 2 in the ACS strategy. BAN is designed to give people the fix to trade sectors who like to trade, and the ACS strategy is designed to grow and protect your capital and not require a lot of work. That's the value. That's what I love about the ACS. It's not about wanting more trades. So there's a big difference between the two. You will have, obviously, if you have more open positions, you got more action, and so that's the difference there. Another member was wondering about the afternoon updates. Now, over the past, if we just go take a look at the markets here, over the past, really the few weeks we got in here, this market's been going sideways for 3 weeks. There's not a whole lot going on. We're on this do or die. Market needs to pick a direction. There's not a whole lot going on, so there's not a lot to update on. It's kind of like sometimes I feel like a musician playing the same song, over and over again. Well, if nothing's really changing, there's nothing popping and standing out. The update is just the same as the previous. If there's something big and changing, that's when I'll do a bigger update, a video update, a written update. But overall, if not much has changed, I generally don't. You just continue on with what we said yesterday. So that's, I think, the best way to look at it from that perspective. And in terms of inverse ETF, some of you are wondering, can we now get into an inverse ETF if the trend is down? No, that's not how the strategy works. We need a lot of damage to the stock market before we go in. It needs to sell off fairly dramatically. I mean, if we were to go back to 2000, we'll just go 2008 here. Where was it? Hold on one sec here. We just go back to 2008. Generally, we need a full-on bear market, so we need all of this damage done. We need all of this damage done through here. And then we'd be looking at potentially bear trades somewhere through here, potentially through over here, and potentially over here. So we're looking for the breakdowns. You get the bounce, an uptrend kicks in, then you get a breakdown. You get a bounce, an uptrend starts, then a new downtrend starts. So these are where we'd be looking for the inverse trades. But the market needs to really break down before we do that. And you're going to say, I know how people are, hindsight 2020, well, why wouldn't we play this downside? There's tons of moves. The way the markets really move, and I'll do another detailed video on this at some point, but these little pullbacks along the way, this is the weekly chart, so you don't see the little pullbacks, but these daily trend reversals like we have right now, they generally don't live for very long. They can get bought back up, and by the time we get a downtrend in the market, so for example, let's go back over here, obviously there's already been a very nice move to the downside. 2 big waves to the downside here. If we were to buy an inverse ETF, this market could easily chatter around and then bounce and start to rally and kick us back into a long-term trend. And really that inverse trade didn't play out because we didn't get that breakdown. The longer-term trend, when we look at it, is still up. You don't want to be buying inverse ETFs when the longer-term tide is still rising. Now, there's going to be lots of noise and chop through these massive trends. but we really don't want to buy inverse ETFs when the long-term weekly chart trend is still up. So that's it in a nutshell. If you don't go crazy with indicators and opinions and you just follow the price action, you have a strategy. We just navigate these markets very, very simply. We know when to hold, we know when to trim profits, we know when to move stops up and to exit a trend, and we can navigate these markets without a whole lot of damage at all. In fact, we can benefit from even a big market pullback here. If the market pulls back for a couple of months, we could be sitting potentially in a cash position or a new position and earning interest and earning dividend payments and having a return while other people are underwater. So all these opportunities, all these movements in the markets are opportunities if you know what you're doing. Anyways, that's it for now. I know there was a lot of you who joined in on the fast. I did the 3-day fast, which is pretty awesome. Everybody, there was about 14 of us, I think, that joined in on that. And feels great. Did a full 3 days and just super good clarity. And Brian, our options guy, provided a lot of good insight on how to do it properly to avoid headaches and stuff. And it's funny because, I've done fasting a bunch of times, but Brian's listed off the 6 things to do. And this time around, I focused a lot on this special Baja Mineral Gold sea salt. And I had a lot of salty water and electrolytes and magnesium and potassium and all that stuff. And I never had a single headache, crystal clear, never got hungry. I'm doing just a 1-day little fast because I had a little, not the healthiest meal yesterday. So I'm just doing another little cleanse today to just retune up. But anyway, all good stuff. Thanks for joining in. And it's always fun to know there's a bunch of us going through the same thing and working to be healthier. All right. Take care, everybody. Bye-bye.